Optional for us, but generally I enjoy coming to office, and it is slightly nearby.
Correct.
So generally I make 3 to 4 days a week like that.
Yeah, I'm sure. I mean, it's much better working from office than working from home.
That's true. That's true. That's true. Somehow the orientation, is slightly different, whenever you enter the office.
Correct.
That's
Absolutely. Your
what.
mindset is completely different as well. I mean, when you're at
Certainly.
home, when you're at work, but then I
Certainly.
think everyone's learning to live with it. And I think longer the people stay at home, I think going to office again for everyone is going to become really difficult.
Yeah, true, 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 true.
So let's see. Should we
Very,
start?
yeah, yeah, sure, sure.
Perfect. Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Ajit Banerjee, CIO at Shriram Life Insurance Company, joining in. Welcome to the show, Ajit, and a pleasure to speak to you as well. Ajit, my first question coming to you is, let's start with the macros. To start off with, we have the RBI policy as well, and they've completely remained in whatever it takes kind of a mode and said that normalization is going to be gradual. What's your view?
First of all, thanks, Hiral, for inviting me to this show. So, well, it was nothing which was quite unexpected, I would say. Market would have certainly, has factored that, RBI would continue to maintain its accommodative stance. So there is nothing which was, anybody was taken by surprise. Only thing surprise which was essentially was when the voting was done. So it was not an absolute consensus view as we see. It was 5:1 as far as this I mean basically rate related decision which was conveyed. So so certainly as a result of which I mean there wasn't much reaction to it in the fixed income market as we see, barring I mean a few generally there is always a little amount of reflections which happen, and it happened so likewise. Only thing is that I mean RBI governor has time and again emphasized on the fact that they will ensure that they will, I mean, not fear of, they will rather ensure that there is a orderly evolution of the yield curve, which is what is continuously or constantly the message which comes out. Which means that what I interpret is that they're aware of the fact that artificially you cannot prolong to keep the yield curve suppressed. It has to gradually move up, but definitely this evolution has to happen in such a non-disruptive way that through the so far the measures that they have taken actually or been successful to I mean basically glide the economy to the recovery part, does not get disrupted by any abrupt increase in the yields. So in a way, actually, we have seen that they have passed on some subtle messages. One was that acceptance of the new benchmark at 610, if we have seen. So, which is, certainly, a step forward, I would say that, they have started now. Earlier, what used to happen, the previous benchmark, 585, 2030, what we used to see, the moment it used to cross, 610 or 615, immediately, they will come to, take some, make some announcements which will bring the yield curve, I mean, the benchmark yield down. But right now they started only with 610, which means that they are basically ready then on accepting that this is something which will the way going forward. Number one. Number two is that even they have enhanced that limit of that that VRR from 2 million to trillion to 4.5 trillion, what they have announced, which also essentially means that basically a little amount of liquidity will be slowly gradually withdrawn. So these are all messages which one has to read between the lines through the actions, because everything cannot be spelled out slow clearly, but you need to read between the lines at what directionally they want to move out.
Right. So with all of this, I mean, you've given us your thought process with regards to how you see the curve from here on. However, do you think that the RBI will continue to keep intervening to keep bond yields in check if there is any event of spike from here on? And do you think there could be an event of spike as well?
See, the fact is that I mean, as we know that there is a once the at the present moment, I would say the priority of RBI essentially is to restore growth of the economy. That's the primary target what they're trying to keep. That is a main point of emphasis what they're trying to lay. So certainly, I mean, once the growth actually picks up the momentum and there is a stability which we receive in terms of which we can see in terms of the growth, in the economy, then they would also expect that, certain amount of inflation at that point of time will be considered as a positive inflation at that point of time. So which is acceptable to the economy as a whole and acceptable to the country also. But till such time, actually, basically the inflation level moves up without a, backup, or rather a support, from the economic growth perspective. I think they would certainly intervene either, through their basically conventional method or non-conventional method what they have been practicing. The moment the yield curve actually moves beyond its basically, I would say, comfort level. But their comfort level, what I feel, is has been revised upward to a certain extent, in terms of what we can see that, 610 this benchmark got issued, but even it moves up to 625, they are not intervening as such.
Correct.
So that's what gives a signal that I think their tolerance level also has certainly moved up, because they know that, you cannot forcefully, keep because there is a law of demand and supply which will come in place, and you cannot keep it eternally like that.
Correct.
So I think that's the directional part, and what I feel. So to cut it short, basically interventions would be there, the moment when it basically exceeds the RBI's tolerance level. And till such time, possibly the, growth and the inflation does not, go hand in hand. Up till that level, it will happen. This is what I feel at this point of time.
Right. So taking all of these factors into consideration, how are you expecting growth and inflation to pan out? Do you think the RBI is ready to ignore inflation in case it spikes, mainly to concentrate on how growth is panning out from here on?
See, what we have seen actually is that, while RBI, even for that matter, transitory inflation is a new catchword that we see from all the central banks, be it, basically Fed or be it RBI, they're using the word transitory inflation, and basically attributing this inflation to mostly this, supply chain related bottlenecks, or, basically supply constraints, as I would say. So, basically, and what we have seen is that recently, to certain extent, RBI's apprehension was found to be in order, because the latest print which has come actually yesterday, the inflation has come down to 5.59%, which is again below their, MPC's target level of, 4 plus minus 2%, which is certainly again happening because of the ease of the supply, as well as some of the steps which government has taken, actually has possibly acted in favor of, containing basically the supply related challenges what was facing. So basically the overall expectation is that yes, there is certainly a mismatch between the demand and supply at this point of time. Presently, the inflation is led by definitely the supply chain constraints that we have, because although we didn't have a basically national wide lockdown this time, but there was say localized state level lockdowns which was happening. So if you aggregate all those lockdowns which was happening in various pockets, it would more or less somewhat certainly it has impacted the supply chains across the country. That is a fact which we cannot disagree. So now that we are, I think the entire country is out of the basically this sort of restrictions. So that would certainly ease out the supply related issues, which has possibly impacted in actually basically impacted in the lower number of inflation print coming out. So I would expect that the inflation level to be fluctuating at the moment, basically in this entire year, till such time like the aggregate demand and supply basically attains a level of equilibrium, is what I can say.
Right. So taking all of this into consideration, how do you think are the FIs viewing the Indian markets? Because last couple of months, there has been a constant outflow that we are seeing. FIs have been sellers, whereas the major support is coming in from the DIIs as well. How are you expecting this act from here on?
Okay. See, basically, FII is also our investors. So certainly any investor will, basically rather trace the markets which is giving them returns, right? So in the initial period of the, basically just post lockdown, when the market was showing recovery, we were seeing that, FIIs were interested, basically in their in Indian markets, and they had put in money. Even now, actually, FPIs, if we see, they are actually still remaining invested. FIIs have partially withdrawn, but FPIs, actually foreign portfolio investors, they are still invested in the market. So that is something which actually, while we always speak about FIIs, but we generally don't speak about much about the FPI investors, in the market. Anyway, what we were trying to say is that initially they remained, invested in our country, but in the moment when they saw their home markets actually have started, generating better returns, and naturally, in any case, we were operating in a situation of crisis, so naturally at that point of time they thought it is much more safety, as well as, better from risk perspective also. So they started withdrawing the money from Indian context, and they were putting it back to their home country. That is what was actually has happened. Now, unlike other terms, when we have seen that basically, whenever the FIIs were withdrawing on a consistent basis, market would collapse. But this time, I think the DIIs, as well as, what we are using the word now, Robinhood investors. So there was a lot of retail investors. Actually, we have many of them first-time investors also. So they have also entered the market, and their contribution cannot be ignored altogether, because the inflows which came, and I think I was reading a report where it says that month on month, actually about 10 to 15 millions of new first-time demat accounts are getting opened.
Correct.
And although, we don't know whether these investors are actually putting in the money after doing the required due diligence or analysis or not, that there is also a risk attached to it. But leaving aside that part at the moment, so because we are talking about the, supply and the stability at this question. So definitely, I think the counterbalancing act has happened. So the market was, I think, ably supported by whatever was the, subtraction which happened because of the FII withdrawals. The DIIs as well as the retail investors have supported it pretty well, so that the market held its level, and actually it improved, month on month basis also. There is also a fact that, because of lack of alternative investment opportunities, I think that was also a reason why basically, money has remained, and the momentum has remained in the equity market.
Right. So with all of this, what's the sense that you have in terms of the markets? Because from the kind of dip that we saw due to COVID in March last year to now, we've seen a fabulous performance. Yes, there have been mild corrections in between. However, right away as well, we've been clocking record high levels. Where do you see it from here on? Because clearly markets are sensing something very much positive in the future. The corporate earnings is pointing out to something, above expectations as well, at least in the last 2 quarters.
Okay, so see, basically, as of now, I guess there is no disagreement to the fact that the market levels are driven by the liquidity. I think there is no, I would say, I think iota of doubt in that, right? It's the momentum investing which is happening now, all primarily driven by the excess liquidity that we have, or at the same time, lack of, alternative investment opportunities, which is actually, in a way, I would say, incentivizing the investors to remain invested. Now, and many of these companies, actually are while the market levels have gone up, but there is no as such discrimination between fundamentally strong companies and not so. So as a result of which, market, while equity investments are always forward looking in nature, and they track the consistent delivery for a long term to come. So whether all these companies actually will be able to deliver this consistent return going forward is what time will tell. So whether going forward also, as today what we are expecting, that earnings, strong earnings growth from, I think, basically June quarter last year, the earnings growth wasn't that good, numbers weren't good, but thereafter from September onwards we saw basically it was moving upside. So, and it has continued to do so broadly up to June quarter as we see. But the fact is that what is going to happen here on onwards? That's the main question what we are talking right now. So to answer it in two part, one is that whether the earnings, basically going forward are expected, if not the quantum of the increase in the earnings may not be that much going forward, because there is a base effect also which comes into play. But at the same time, earnings growth would be certainly there, but definitely the delta of that, earnings, what we have seen in the last year, it may not be possible across all sectors going forward. That's number one. Number two is essentially that the market movements, whether how long it will sustain. That is certainly another thing which is important to basically, I guess, have a clarity on that. So as we are saying that this is predominantly a liquidity driven rally, hence, if it so such happens that, the liquidities, the asset class, allocation of the investor starts moving to alternate investments like bond, because of the increase in the bond yields and all, then it might so happen that a lot of money actually might start moving out from the equity asset class. So once that happens, there can be a bit of a panic sales also happening. So which might lead to some amount of corrections in the equity market. That is something which we can expect, but that is not going to possibly happen abruptly, because basically situation of excess liquidity that we are seeing now will not be, we cannot expect that overnight the situation will change. That is going to continue for some time, because I mean, central banks, be it abroad as well, I mean, Fed, or be it even your ECB as well as RBI also, will certainly ensure orderly evolution, as we are saying. So this situation of excessive liquidity will gradually be withdrawn. Until such time, I think we can expect the market to move sideways. There will be an upward bias, but there may not be a phenomenal growth from what we have seen, from last year, is what my take is.
Right. So currently, overall, do you think someone should invest from a longer term perspective from here on, or would you advise the investor to wait for corrections?
See, actually, basically, this investment decision, I mean, depends on a number of factors. One is certainly the investor's risk appetite. Investors basically, profile also, as well as his investment horizons. So and basically at I mean, which part of his, I mean, if it is an individual investor, at which age group does he belong to? How much, I mean, he can risk, he can absorb. What is his basically other, financial commitments that he has? It's a combination of various factors, right? As so, I mean, as far as say maybe a PMS, I mean, investor, or basically for that matter a HNI client and all, who has a long-term investment horizon, it may make sense to invest in tranches, rather than invest in basically one whole lot. Because whenever you invest in tranches, actually there is always a averaging out that happens. So, I mean, my advice would be that, if you are a long-term investor, basically I mean, with certainly a risk appetite to stay invested for some time, then I would recommend to invest in tranches as opposed to invest in one lot at this point of time.
Right. And overall, what would your recommendation be with regards to an asset mix? For example, if I have 100 rupees to invest in, how would you advise the investor to, invest in terms of different assets? What should the mix look like?
See, that again, as I said, that it is slightly has a correlation to my previous response, in the sense that it depends upon definitely investor's profile, his risk appetite, and his investment horizon. So actually, at basically, if an investor who is, I mean, basically in his early age of, and certainly has then, I mean, not much of a financial, basically, I mean, commitment to meet, then certainly he can make an higher allocation in terms of possibly, I mean, again, in a gradual way. I would not at this juncture, basically recommend that where the markets are already such elevated levels, that, to put basically 50, I mean, suppose, as he said, that if he has to put in 50 rupees out of his total investable surplus, I mean, he should put it in tranches of, maybe 3 or 4 tranches, so as to say, so that he can make a gradual, his cost becomes actually a bit of average out which can happen over a period of time. So maybe again, if he is of, a person within up to 30 years of age, maybe at this point of time, in a gradual way, he can put up to say 70 in equity and then 30 in a basically in a fixed income assets, because at any point of time it has to be a balanced investment, basically allocation, asset allocation one has to follow. There should not be extremely skewed towards any asset classes. But yes, that depends upon also the age as well as his risk appetite and his personal commitments that he has. There is no as such straight formula that you can straight away apply that formula and put the money like that. Yeah.
Right. And very lastly, Ajit, overall, in terms of different sectors right now, what would the top sectors be that you would be watching out for, where you see right value and again, the risk reward is favorable?
See, as far as again value investing is concerned, so basically at this point of time, there are still some, I think, I would say, opportunity available in the mid and small caps, but one has to be very selective in terms of picking up the market leaders in those particular sectors. For example, as we see that many IT companies are still in the, because see, this IT demand what has arisen, has basically arisen after the post pandemic. Enterprise across the globe has realized that that is going to stay. One has to be, it has to be successful in terms of uncertainty. Then definitely those who are successful have spent a huge amount on their IT infrastructure, IT capabilities, as well as IT network spends and all that. Those are the companies which are successful. So IT will be a long bet at this point of time. And there are companies which are operating in the basically mid cap segment, where one can definitely choose do a due diligence of those and invest over there. Then we can also see that some of the see, reality sector again is basically what we have seen out of this pandemic now. There is a good amount of demand which has started, in the household reality sector. So there are, some companies in that space, as well as reality aligned companies, which I would say, for example, those which are manufacturing, ceramics, then basically, tiles, paints, and like that, actually. Those are the companies where the demand is going to stay for quite some time, as we are seeing. So there are some value picks which are available over there, as well as, chemicals also, agrochemicals and specialty chemicals, which have not yet still picked up the favor, are the ones where one can definitely find some value stocks at this point of time, is what I feel.
Right. So these are few of the sectors one should be watching out for as well. Thank you, Ajit.
As far as the value stocks are concerned, but as far as large, if one has the appetite to invest in large caps, there are certainly, see, right now, since growth remains the main feature of the main focus of the companies of the countries, actually, long-term growth, and government of India also is emphasizing quite a lot on that. So we can certainly see a good amount of spending which will be happening, by the government in terms of infrastructure, as well as other infrastructure related projects. So definitely those companies in the cement, steel, are the ones which we can see a good amount of basically growth to come in, and demand to sustain in the long term, as well as quality banking stocks, basically, because in any infrastructure spending has to be highly dependent upon the growth of the financial sectors also. So financial sectors also cannot be ruled out for the long term, if you have that appetite.
Right. So again, growth and value investing, two different aspects that one needs to consider as well, while making investment bets on the sectors that Ajit already mentioned. Thank you, Ajit, so much for joining us on the show.
Thanks.
Pleasure to speak to you. Great insights. Thank you. Stay safe and speak to you soon again.
You too. Thanks a lot. Bye.